So China is selling off US Treasury bonds. Some people are calling it the nuclear option. A financial strike that could shake global markets. And just hours after Beijing dumped bonds, they hit back even harder. A 125% tariff on all US goods sold in China.
That's not a typo, 25%.
All of this comes after President Trump slapped a 145% tariff on Chinese imports. And this isn't some tit-for-tat headline. This could reshape the entire global financial system. Now, you might be thinking, okay, what does this have to do with me? Mortgage rates, 401ks, the cost of your groceries, car, and credit cards. Everything could change. And here's what I've learned. Right now, the most important thing to watch isn't the stock market. It's the bond market. And more specifically, interest rates. Because those yields, they're spiking. And if that continues, it could trigger a massive chain reaction. So today, I want to break down what's actually happening behind the scenes. Because this might not be an economic accident. It might be a strategy. A coordinated effort to trap China financially, just like we cornered the British pound in the 1990s. Stick around, because once you understand how this works, you'll see how this affects everything from the Fed's next move to the fate of the US dollar to your own investments. Let's break it all down. In early April 2025, something happened in the bond market that rarely occurs. A massive sell-off of US Treasuries. Now, quick definition, Treasuries or bonds. I'll use the words interchangeably. But there's one that really matters, the 10-year Treasury. It's like the heartbeat of global finance. And the yield on that bond? It just spiked. Which is exactly what we don't want. Why? Because when yields go up, borrowing costs go up. And that can break entire economies. So who's behind this? All signs point to two players, China and Japan, the two largest foreign holders of US debt. And guess what? They're both unselling. Now, China has been slowly backing away from US debt for years. By the end of 2024, they held just $760 billion in treasuries, the lowest since 2009. But in April, it accelerated. And it started with one move, tariffs. On April 9th, President Trump announced a 104% tariff on all Chinese imports. China responded with a 50% tariff on US goods. Trump then raised it to 145%, and China came back with 125%. All of this happened in just 1 week. And while this was happening, Trump paused or reduced tariffs for other countries. This wasn't a global trade war. It was a targeted strike. And China fought back hard. Not just with tariffs. They filed WTO complaints, restricted 18 major American companies, cut rare earth exports, and they began selling US Treasuries. That last one? That's the big one. Because selling US bonds causes bond prices to fall, which forces yields to rise. So let's talk about why this is such a big deal. See, most people think the Federal Reserve sets all interest rates. Not exactly true. Yes, the Fed controls short-term rates, like the federal funds rate. But long-term rates, like the 10-year Treasury yield, those are set by the market. If countries like China dump bonds, bond prices fall and yields go up. Let's break that down with a simple example. Say a bond pays you $50 a year. If you paid $1,000 for that bond, that's a 5% yield. But if the bond drops in value to $900 and still pays $50, now the yield is over 5.5%. That's what we mean when yields rise. It means prices are falling. And they're falling because someone is selling. Now imagine China and other nations dumping hundreds of billions of dollars in bonds. That's what we're dealing with right now. And when yields spike, borrowing gets expensive. Mortgages go up, car loans go up, credit card rates explode. And the US has to pay way more to service its $30+ trillion national debt. That's why people are freaking out. And that's why the Federal Reserve might be forced to cut interest rates. Not because they want to, but because China might leave them no choice.
Now, before we go deeper, if you're finding this breakdown helpful, smash that like button and subscribe.
It seriously helps a ton. And if you want to stay ahead of economic chaos like this, don't miss the next one. Okay, let's go even deeper. There's a theory going around that this whole thing might be orchestrated by Scott Bessent. Now, if you don't know who that is, he's Trump's Secretary of the Treasury. But more importantly, he helped break the British pound. Let me explain. Back in the early 1990s, the UK was part of something called the ERM, the exchange rate mechanism. It was basically a European currency agreement. The UK had to keep the pound within a fixed range. But the economy was weak. Inflation was high. Interest rates were unsustainably high. And Besant, along with George Soros, realized something. The UK couldn't keep defending the pound. Eventually, they'd crack. So they bet big. They shorted the British pound hard. And on September 16, 1992, aka Black Wednesday, the UK was forced to withdraw from the ERM. The pound collapsed. And Soros made over $1 billion. Scott Besant was the architect. So what does this have to do with China? Well, this looks a lot like that strategy. Because right now, China has two choices. Option 1, weaken the yuan to make exports cheaper. This would help offset the US tariffs. But here's the problem. A weaker yuan could trigger panic. Capital flight. People moving money out of China. Inflation would spike. Their banking system could destabilize. Option 2, defend the yuan's value. To do that, they need dollars. And to get dollars, they have to sell US treasuries, which is exactly what they're doing. So while this looks like retaliation, it might actually be desperation. They're doing it to protect their own system. And here's the kicker. The US is facing the exact same dilemma. Because every time China sells treasuries, yields go up here. And that hurts us too. Higher yields, higher debt payments, it's slower growth. So both countries are stuck, caught in a game of financial chicken, each waiting for the other to blink. It's a race against time. And if China runs out of dollar reserves before we back down, game over. But what happens if China keeps dumping treasuries? Here's the danger. Yields spike. The Fed panics. And we enter QE 2.0, massive money printing to stabilize the market. And if trust breaks down completely, we could see a financial decoupling. Two global currencies, two trade systems, two internets. We're not there yet. But we're a lot closer than people realize. So what am I doing? Let me share it with you. First, I'm staying invested. I dollar cost average into VTI, Vanguard's total stock market ETF. And I'm still buying Bitcoin. When prices dip, I buy a little more, and I immediately move it to cold storage. Because in moments like this, you want assets that can't be frozen. But more importantly, I'm not trying to time this market. Because historically, the winners are the ones who stay in, not the ones who guess. So yes, this is a crisis. Yes, it's scary. But these moments, they're also where wealth gets built. Because fear creates opportunity, and knowledge gives you clarity. So stay curious, stay smart, and above all, stay in the game. If you made it this far, thank you. Smash that like button. Subscribe for weekly insights like this. It helps a lot more than you think. And I'll keep bringing you the real story behind the chaos. This might just be the start of a new financial era, and I want you ready for it.